If it's 50% occupied, you can go buy it at a 7 cap when you're borrowing at 7% because you're going to grow the NOI so much that it doesn't matter.
Yeah.
Heard. I hear you.
Yeah.
Get it?
Yep.
Don't leave a comment in the YouTube.
Yeah.
Don't do it. All right, what is up? And welcome back to How to Invest in Commercial Real Estate. Arguably the best podcast
in Jinx,
Oklahoma.
What is up? Hopefully you guys have been watching the Olympics.
I have.
Because I think it's fantastic. I love it. I mean, I wish it was every year. It's only every 4 years.
Yeah, it's a lot of fun.
Yeah, what'd you guys think of the opening ceremony with the river? Not necessarily one of my favorites as far as some of the ones I've seen. It was cool.
It was in the rain, that's for sure.
Yeah.
I thought it was kind of cool. You know what I thought was really cool was the Olympic torch.
Yeah.
The balloon. That was pretty unique. That was cool.
I'm always fascinated by superior humans doing their thing.
The feats are amazing.
Yeah,
absolutely
and making
amazing.
us look like average people.
What I think is insane is how close all of them are.
Yes.
Most every sport is insanely close outside of Katie Ledecky. I mean, it's got to be just it's got to suck swimming in her events.
Yeah. This is kind of off topic. We may cut this. I don't know, but Ledecky killed the field, right?
Yeah.
And we're like, oh, it's because she's such a superior athlete. It's just what she is. And then the Chinese swimmer breaks a record. And they're like, they're all doping. They're dope. They're cheating.
Yeah.
And I'm like, I don't think we should go there, right? We don't go there when Americans win by a good amount of time, a good amount of distance, right?
Yeah. Right.
So I think we got to be better losers and not start accusing everyone when we lose.
And in fact, I'd say you're one of the best losers I know, Joel.
Yeah.
Yeah.
I try.
Did you see the 62-year-old ping pong lady won a medal?
No.
Pretty sick.
Brian, there's hope, bud.
What is it? The Ukrainian guy in the shooting competition.
That's the best.
His pose became famous. Just hand in pocket, no eye gear.
No eye gear, no sighting.
Nothing.
T-shirt, shorts.
Yeah.
He
He just got back from the war. Like that day. He's like, this is how we do it.
I want to do. Did you call him a Ukrainian?
I didn't know what country he was from. What country was he from?
I think it's Turkey.
It was Turkey?
I think
okay,
so.
Turkey.
Yeah. What I'm a little disappointed though is we stopped the game at about halftime and USA's losing to Serbia in basketball.
Yes.
So that game's
Serbia's
not over as of this taping.
They got the Joker though.
I know it.
He doesn't
He's
miss.
Good. Yeah, he's good. I don't know if you know this. Curry had 16 or so first quarter points.
Oh,
Or
nice.
14. So
Wow.
he has half our points at halftime or something.
That's nuts.
So we went to CCIM luncheon here in Tulsa yesterday. We'll plug that a little bit.
It's always a fun time. I enjoy it.
I can't say that there was a plethora of high quality real estate being tossed around there. Some of it was a little bit rough. I got to be honest.
There's not a plethora of high quality real estate being sold in Tulsa generally, which is why we find ourselves buying so much real estate out of Tulsa, I think.
Yeah, that's a fair point. But if you want to get plugged in and you actually live here in Tulsa, some really great people, you can get connected. You'll get ideas for new deals, but there's also vendors that'll help you manage and the maintenance on your deals. All the vendors are there, the brokers are there, so it's a good avenue to get introduced to people.
Golf tournament's coming up.
Yeah,
Best event of the year, guys. You're in Tulsa. You want to go to a fun golf tournament?
It's fun.
CCIM golf tournament. And it's not at Forest Ridge this year, man. Forest Ridge is so freaking hard.
Where's it at?
I just suck at golf too. That doesn't help.
yeah. When I hit it into the forest, it's just gone. I don't even.
Yeah. It's because the forest is there. If it wasn't,
I take 10 balls, 12 balls, and
hole?
expect to lose most of them.
you remember when Brian made it through the entire Phoenix trip without losing a ball?
That was crazy.
2 rounds, 36
I think I
holes.
was down 8, 9.
Dozen.
I don't know what. I hadn't played like that since, unfortunately.
Yeah.
All right, topic for today. We thought we would kind of go back and discuss some of the important metrics on how we quickly evaluate commercial real estate deals. And so the terms we're going to be talking about today that you need to know and you need to know how they interact with each other is cap rate, number one. Then we go interest rate, number two. I think those might be the two most important right there. Mm-hmm. If I was going to sum up commercial real estate with two terms, it would be cap rate and interest rate. But then also leverage can play a role. And IRR is another one you need to know. So should we give real brief definitions for the audience on those?
Yes.
All right, cap rate. We've gotten into a lot of heat with the cap rate discussion.
Here we go.
But let's keep it simple. If you have $1 million deal and you pay all cash for it, what cash flow can you expect year one? Right? That's pretty easy, right? So if it's an 8 cap deal, 8% capitalization rate, that means if it's $1 million deal, it's going to shed $80,000 of cash flow. Okay.
Yep. Yeah, it's your unleveraged NOI divided by your purchase price at the time of sale, at the time of evaluation, right? You could argue in that first 12 months the NOI is going to go up, but at the time of sale, day one, it's that formula. Your purchase price or your NOI divided by your purchase price.
Yeah. And so that's a big one. Of course, interest rate is just what interest rate the bank is charging you to borrow the money. Mm-hmm. Leverage point is how much of the deal can you borrow from the bank. So on $1 million deal, if you have a 70% loan to value, so 70% leverage, that's a $700,000 loan. That means you got to come up with $300,000 in equity. Okay.
You know, I think another word we have to add to the list is positive leverage, right? Because that's the beauty of real estate, is being able to go buy something that makes 10% and borrow the majority of the money at 8% or 7%, right? Then you have that delta. You know you're making 10% in this deal, but your cost of borrowing the funds to acquire the deal is less than the deal makes, right? So you have a positive leverage point there making you money.
Yeah, and that's a great point. And then IRR is kind of the number that puts it all together. It takes into account everything that's going on in the deal, and you assume a sale price in the future, and it gives you your average yearly return.
Yeah, the sum of all cash flows divided by the total time period the dollars were in the deal.
Yep. IRR, internal rate of return.
Internal rate of return, yeah. It's a little bit complicated, but it's an important one. So what we thought we'd do today, because we've had high interest rates now for a year and a half, 2 years, and kind of slowed down the market a little bit. Because just like if you're thinking about purchasing a house, if you're in a house right now and your mortgage is 3%, do you really want to go buy a house and get a 7% mortgage? Right. No, you don't. So what it causes people to stay where they're at. Well, same in commercial real estate. Is they can't get the best price for their deal when they're selling in a market that interest rates are high, because the cost to borrow the money to buy it is really high. And so, it causes the deals to kind of stagnate.
Which is when you should be buying, right? Because nobody's selling in a market where they know they're leaving money on the table unless they have to. So if you're buying in that market, you're immediately getting a deal.
Well, yes. So your point is accurate. That is a good time to buy, but not at first, because cap rates lag interest rates.
Right.
So let's say a $1 million deal has $80,000 in cash flow. It's an 8 cap deal, and you could have purchased that and gotten a 5% loan or a 4% loan. But if the cost of debt goes up to 7 or 8, right, the cap rate isn't going to move overnight, right? The seller's like, I still want the price I want. And so what we've been doing is kind of waiting these last couple of years, and cap rates are moving slowly up because people have to sell for whatever reason. And, and that's what kind of brings those cap rates up. Because if you do have to sell, you're going to have to sell at a lower price, and a lower price means a higher cap rate. And so that's what's caused them to move up. And right now we're in a situation where rates, I think, have stopped going up and are about to start coming down. And so we are actively trying to buy as much as we can right now.
That's a good time.
Real
if rates
quick.
are going to go down and prices have come down, this is the right time.
Did you say if rates go down?
I said if.
Okay. You think rates are going down, Brian?
I didn't say when.
When do you think rates are going down? When do you think we're going to see a first rate cut over there, Brian?
By the end of the year.
Oh, we got to replay the tape.
Yeah, I like it.
I hope it's before the end of the year.
By a quarter of a point.
Interest rates and cap rates do have a correlating relationship, right? Interest rates go up, cap rates go up, but they lag a couple quarters, I would think, in a traditional thing, as long as the interest rates aren't immediately corrected, right? We've seen for a year steady now, maybe longer, interest rates just continually go up. So as an investor, for sure, if you can wait it out, we found ourselves offering on the same properties over the course of 6-9 months just because it was still on the market, and deals would just stagnate, and you find nothing is priced right, and you have to reach out to the broker a lot more because everything is still priced at, hey, this is the 8 cap deal, and right now with the cost of capital just being raised so much, it's a 9 cap deal. I'm still good for the 9. Call me when you're ready to take it. a lot of people started calling back and adjusting prices, and stuff started trading 6-9 months later.
So we have a few numbers that we're going to go over with you just to kind of give you some examples. But typically, like you were saying, positive leverage. Let's say that $1 million, you wanted to buy $1 million piece of property, and it's making $80,000 a year, or 8%. And let's say the bank will loan you money at something less than 8. Well, that's how you know you're gonna make money. And how the simple way to think about it is, what if the bank would loan you 100% of the deal? So you have $1 million property, and the bank will loan you $1 million. And let's say that it's doing 80% or 8% cap rate, or 80,000 in cash flow, but the bank's they're gonna make you borrow it at 6%. Well, that's going to cost me $60,000 in interest.
Yep.
Okay, and if I can borrow the 100% of the deal, then I make $20,000 right for nothing. I didn't put any money in the deal. The bank loaned 100% of it, and so that's the power of positive leverage in the simplest form. Now, we can't get 100% financing, but at least it shows you that borrowing money to buy a deal at less than the cap rate is the whole ball game in commercial real estate. That's literally what we do best. It's what we focus on, is getting a spread between the cap rate and the interest rate.
And it's not always that easy of a calculation, because you are paying principal back at the exact same time. But yeah, a lot of the times it's that easy.
Yeah. But if you loaned 100%, I guess you have a principal pay down, but that money you're going to get back. So it is a little bit complicated. So in our example, we start off, we took $1 million example because it's just easy.
That's our budget. We have $1 million.
Yeah. I mean, the thing is, the numbers are exactly the same on a $100,000 deal and on a $10 million deal, right? The numbers don't change, the percentages. So you can really apply these types of returns to any deal that you're looking at. The main thing is, what's my cap rate, what's my interest rate, and what is my leverage point? And from there, you can kind of get an idea of what kind of returns you're going to make.
Yeah, full disclaimer, we had an exit assumption of the exact same as our acquisition cap rate. So if we acquired at a 9 cap or 90,000 NOI on the $1 million in purchase price, we assumed we were exiting at a 9 cap. Obviously, real world scenarios, you're typically not exiting at the same cap rate you're acquiring on. Ideally, in the world we're buying in right now, we think we're going to be selling for a lower market cap rate than we bought on, because hopefully it'll be a stronger economy, but that can fluctuate. The other thing that can fluctuate in between these deals that we didn't want to mess with for the sake of the example was rent growth disparity. So all of these properties have 3% annual rent growth. From our experience and how we underwrite, we feel like that is very achievable generally across the board in retail. Most asset classes, I would say. Most asset classes, you're probably getting a lot more. But yeah, right now, I think 3% annual rent growth is very achievable. Can't imagine anybody knocking us on that.
Yeah, I mean, okay, could it be 2? Could it be 2%? Sure.
Sure. Could it be 5?
Yeah.
Yeah.
So, yeah, we got to have some, assumptions here to make this easy. Another thing is the loan. We talk about a 70% and an 80% leverage point, but we're doing all the loans on a 25-year AM.
Yeah.
That's very typical for retail. Obviously, you can get a 30-year on some and a 20-year on some, and that'll change the cash-on-cash numbers. It won't change the IRR numbers much. So those are kind of the baseline assumptions.
Also, these are deal level returns. So we're not considering any waterfall, any splits, anything like that. This is assuming one person buying something themselves or a group of people buying something and just splitting the cash flow proportionately. Last assumption, then we'll stop talking.
Stop talking assumptions.
It's a 2% cost of sale. Also very reasonable, right?
Yeah.
Okay. All right.
Well, Brian, so the first example I think we talked about was a 9 cap deal, which they are available on the market. I think retail is probably easier to get a 9 cap than multifamily. Multifamily typically is a lower cap rate asset class. So we're doing a lot of retail, so that's what we're talking about today. And we assumed a 7% interest rate on the first example.
Very real today.
Yep.
Yeah, today, right now, you can go out and get a 7% interest rate, and you can find a 9 cap deal. And so let's look at a couple different leverage points. Let's look at 70% and then 80% on that first example of a 9 cap deal with a 7% interest rate.
Okay. So yeah, at 70% LTV, The 5-year cash on cash average was 12%, and the IRR was 20%.
Yeah, that's fantastic.
Yeah.
Right. I think that's really, really good. So, if you think about it in simple terms, no matter what deal you're looking at, 2 points of positive leverage, cap rate over interest rate, produces a 20% compounding yearly return and 12% cash on cash.
Right. And at 80% LTV, the cash on cash 5-year average went to 14%, and the IRR went to 25%.
Nice.
Yeah.
That's great. So we just went to the CCI luncheon yesterday. We talked about that, right? I can't tell you how many people in that room said how slow and boring everything is right now. And Criterion, we are freaking slammed right now. Precision, you guys are really busy right now. So I love talking about this because we just said you can find 9-cap deals on the market. We just said you can get interest rates and borrow money at 7%. And we're going through these returns, and these are winners, right? Like, what was that last one? 20 what?
25.
25%. You put some splits on that as a sponsor, and you go figure out how to raise $300,000. You're a happy person. Yeah. You have happy investors. You're making a great return, right? Today, the worst real estate economy ever. Today.
Yeah, and once again, the numbers will work. If you're getting 2 points of positive leverage and you're getting an 80% loan, and using some of the assumptions we've already talked about, like these are the returns. Whether it's a $4 million deal, a $350,000 deal, right? The math is the math, and so
the math is the math.
Yeah, like it is. It just is, and you can trust it. Now, obviously, there's nuances to all these deals, and we've talked about that in another podcast. But I'm just talking about quick analyzation of a deal. If you're looking at a deal that you think you want to buy, and it's at a 9-cap, and you can borrow at a 7, you're going to make money on that deal.
More importantly, if you know you're going to borrow money at 7, you shouldn't be looking at at much less than a 9-cap, right? And this is where I'm going to get some flack, right? Because people say, well, it's a 9-cap because it's got vacancy and so much upside for you to grow the NOI. I get that. I hear you, right? That's too complicated for this podcast right now. I hear you. Like if it's 50% occupied, you can go buy it at a 7-cap when you're borrowing at 7% because you're going to grow the NOI so much that it doesn't matter.
Yeah.
Heard. I hear you.
Yeah.
Get it?
Yep.
Don't leave a comment in the YouTube. Yeah. Don't do it.
We've talked about that stuff in other podcasts.
So, and we did this just to kind of prove a point. We looked at what if you're looking at an 8-cap deal and interest rates have come down some and it's a 6% interest rate.
Yeah. We actually looked at 5, 6, and 7% interest rates for a 1, 2, and 3-point spread.
Okay.
So let's go with just a 1% spread. 8-cap at 7%. At 70% LTV, it's 8.5% cash on cash and 18% IRR. So that's just with 1 point spread.
That actually, to be honest, being a professional in the field, that surprised me.
It's fantastic.
And 80% LTV is 9% cash on cash and 22%.
Okay,
IRR.
so worst case scenario, right? Like S&P 500 over the past 30 years has averaged like 9 something percent. Yeah. So you're getting that return in cash paid out quarterly, which the S&P 500 doesn't pay out an 8% dividend. Right? It's just the value of the stock. And then you have to sell it at some point to actually realize the full 8%. Yeah. Versus real estate, you're getting the 8% in cash, but when you sell it, it cumulatively adds up to 18% per year. Again, You do your retirement calculator on 18% per year. Let's just discount it some for risk. Let's call it 15. Let's call it 14, right? Like, don't believe in the system. Be modest. Sure.
Yeah.
But every now and then you're going to hit 18. Every now and then you're going to hit 20, 21. It's going to be nuts. And then we've done these episodes on discounted cash flow calculators at 18%, right? It's millions and millions and millions of dollars if you keep it up for a few decades.
Yeah, for sure.
Okay, then we did with 2% spread, an 8-cap with 6% interest rate, 70% LTV is 10.5 cash on cash, 19% IRR, 80% LTV, 12% cash on cash, 24% IRR.
And so really what that was showing me is that the 2 points of positive leverage going, buying at an 8-cap and getting 6% interest was very similar to buying at a 9 and getting a 7% interest. Yeah. Right. Yep. So really, we talked about this before the show. If I could give you one number, the most important number is the difference in cap rate over interest rate. That might be the number one thing you need to know in order to have the best returns. Is focusing on that difference. And where we made a lot of money just 2 or 3 years ago was buying at 8 cap and getting 4%.
Ooh,
4.25%. And so now we were getting to the investor, we were getting 20, 25% IRR, and that was on top of the promote that we were taking, because there was just so much cash flow there because of that 4 points of leverage.
What was this latest stat on Plaza West that we did? Do you guys remember that? It's
I don't, not off the top of my head.
Niall was working on it. Okay, say something. I'm gonna find
Okay, you find that, because we also did a 3% spread, 8 cap with a 5% interest rate, 70% LTV, 12% cash on cash, 21% IRR, 80% LTV, 14.5% cash on cash, and 27% IRR. So that's pretty
good. So you really start. I mean, if you can get 3 points, you really get there at 4 points. That's probably a 30% IRR deal level, and maybe a 16, 18% cash on cash. So that's a pretty easy metric when you're looking at this, guys. Is talk to local lenders. Hey, what's the going rate on retail? I just had lunch with Chris Myers at Stride. No, he's at Stride. Yeah. And
the poor guy switches so much.
I know.
I don't blame you, but right now he's at Stride.
But he's all over 6.5 to 7% on his interest rate right now. Okay, and so we know we can buy good real estate at 8.5 and to 9 cap. And so that's my 2 points that I need in order to make it an efficient investment vehicle. So
Plaza West, I just ran an IRR metric because we're about to run this Facebook ad. To date, as of the end of the second quarter of 2024, we bought it in January 22. So we've got 2 years and 1 quarter, 9 quarters. We have a 69% IRR on that shopping center deal. Because we bought it at an 8 cap. We had 4 points of positive leverage at 80% LTV. We sold off the out parcels for like a 6.5 cap when we bought it at an 8, made a bunch of money there, paid down some debt. Anyway, if we were to sell that asset right now, give the investors another equity check back, even though they already got their initial equity check back, they would get another one. They would get a 69% IRR. Home run on that deal, right? Home run.
Okay, and just out of curiosity, we did one more example. We kept the cap rate and the interest rate the same at 7% cap rate, 7% interest rate. Still at 70% LTV, 5% cash on cash, and 15% IRR. And
hopefully you did that right, Braden.
And we didn't do one at the 80% LTV, but
no, it's still that actually was a little bit shocking.
And so what? Tell us why? How are you making money when your income and your interest rate are the same?
Well, you're not making a lot. I mean, 4 or 5% cash on cash. Another disclaimer on these is we didn't get into the fees, and so you could take off a little bit of these numbers. Yeah, I know we did some, but you're going to have some acquisition costs and some fees associated with buying these properties. It just gets complicated, but you could take off a point or two on these returns if you wanted to. Pretty easy to take that into account. So if you brought in the fees in that deal with equal leverage, I would say you're probably 3-4%. And the reason is your even leverage on the $700,000 you're borrowing. Let's say in our $1 million example, but the $300,000 you're still making an effective return on.
Yeah.
And so that's where your return is coming.
Well, and you're getting rent growth, right?
Yeah, and you're getting rent growth, and we're taking an average cash on cash. So year one, you're virtually zero. Yeah. But then you increase the NOI by 3% a year, and so you grow it up to 6, 7, or 8, and then the average is 4 or 5. Yeah. But still, that shows you that you could buy an even leverage deal, cap rate to interest rate, and if you have a path for rent growth, then you still could make money.
Yeah, and the IRR is increased because you're paying down some debt while you're
and you're increasing the rent. Yeah. And guys, we typically don't try to sell at the same cap rate we buy at, and there's a lot of industry experts that'll say, well, as deals age, you need to increase the exit cap. So if you buy at a 9, you should theoretically put in there, if you're going to hold for 5 or 10 years, a 9.5 or a 10 on the exit.
Maybe in a declining market. I mean, an increasing market with positive population growth, job growth, good, strong economics. There's no reason why that asset would just be worth less, in my opinion.
Yeah, I think the argument goes, well, if you hold it long enough, it becomes, let's say it goes from a class A to a class B, an older asset, and that has to come down in cap rate some. But we're going to do a show where we address this, that we're buying 9 cap deals that I think should be 8 caps. And in fact, we're going to prove it to you in a future podcast where we're going to show you where the 2 identical deals are on the market. One's asking an 8 cap and one's asking a 9 cap. And there isn't any reason for the difference other than seller circumstance. Mm-hmm. And so we try to look for deals that we think we can reduce the cap rate on the exit. So maybe we buy it at a 9, but we think we're going to be able to sell it at an 8.5, just because of what we're talking about, that we don't know why it was priced at a 9, but it looks really close to ones that are priced at an 8. So,
yeah, I mean, even the St. Louis deal, right? We have the ability to spin off the pads. That's easily worth sub 7% cap. We bought it at a 9. So if we do that and then still sell the big box behind it for a 9,
you're effectively an 8.5, probably.
Yeah, you're winning.
Yep.
Well, I think we probably, anything else we need to cover on that for today?
Nope, that's all we did.
But just little things, guys. Just that difference between cap rate and interest rate is really a lot of what we try to achieve when we're purchasing. What cap rate can I buy it at? What can I get my debt at?
Positive leverage. I would encourage people to look into other investments where you can generate so much positive leverage. I think that's, outside of the tax advantages, being able to create so much positive leverage so easily. It's so normal. Everyone creates positive leverage when they're buying real estate. Like, it's very rare people are buying in cash. And even the people who are super low leverage are generating positive leverage. That's the name of the game in real estate. So the more comfortable you are with these levers, in your underwriting models, the easier and faster and more deals you'll end up buying. Anyway, we will catch you guys next week on how to invest in commercial real estate.
Thanks.
Thanks.